On August 24th, when the stock market sold off at the opening bell, ETF pricing went haywire. Today on ETF Exchange, Martin Small from BlackRock and Todd Rosenbluth from S&P Capital IQ are joining us to talk about what happened that day and what the industry and regulators are doing to prevent it from happening again. Welcome back to ETF Exchange. Gentlemen, thanks for joining us today.
Thanks, Greg.
Thank you. Great to be here.
Todd, I wanted to start with you and ask you if you could frame for us the topic of ETF volatility and what happened on August 24th.
Yeah, so we saw the stock market, the Dow and the S&P 500 index, indicate that it was going to trade off sharply at the open on August 24th. But what ended up happening was ETFs that were tied to many of these stocks on the New York Stock Exchange fell much further. They fell 20%, 30%, whereas the S&P 500 index was down much less than that. Now, people have to remember that an ETF is a basket of stocks or bonds, and as such, it's going to trade based on what's inside that ETF. And if the stocks aren't open, then an ETF is going to be trading on imperfect information. When that happens, investors can see prices that are much different than the net asset value of the ETF.
I think that's right. I mean, really, ETFs transmit what's happening in the stock market. They don't cause what's happening in the stock market. Right. So on that morning, we also saw securities like JP Morgan, Ford, General Electric trade at prices that were sharply away from where the broader market trade. And that's why we had certain things transmit themselves through ETFs in a similar fashion.
And in the aftermath, Martin, what has the industry done, and you guys at BlackRock have been active in working through these issues and working with regulators to prevent this from happening again. Can you tell us a little bit about what's been going on behind the scenes since then?
Absolutely. So I think we started by doing a lot of work really on dissecting what happened, a lot of analysis to understand all of the contributors to what we saw on August 24th. And then we really moved to action. And action was the following, was creating a white paper that outlined the facts of what happened on August 24th that really gave rise to a series of recommendations about how we can make August 24th not happen again. And then what we've been doing is working with industry participants, the stock exchanges, and regulators on two basic sets of actions. The first are basically enhancements to equity market structure, or things where we can improve market safeguards around stock exchange opening procedures and around recently enacted rules to curb market volatility. And the second is working with clients and working with home offices to basically put in place speed bumps or other warnings or simple things like if you send an email, it might ask you, are you sure you want to send this email? If you're going to purchase or sell an exchange traded fund, are you sure you want to do it with a market order? You might consider a stop loss order.
And that's important, Todd, right? Particularly for advisors. If market volatility spikes like that, as you talked about, understanding how these things trade, correct?
Right. So an ETF is different than a mutual fund, and it has pluses and minuses with that. But one of the big differences, whereas a mutual fund, you put in an order and it gets executed at 4 p.m. after the market closes. An ETF, you put in the order, it gets executed intraday. That's great if you want to be able to trade intraday and want the benefits of trading intraday, bearing in mind that the market may be volatile. The other thing is that an ETF trades off of its net asset value. Now, it often trades very tightly within net asset value, but the price can be different, and as we saw happen, it can be notably different during times of market volatility. So we think investors need to understand that an ETF will often be different than its net asset value, and also just don't put something in and hope that it's going to get executed without understanding the ramifications behind it.
ETFs allow you to trade at a purchase or sell an ETF at a known price. And if you think about August 26th, for example, 2 days after August 24th, if you had executed a bunch of sales or purchases in the morning of August 26th at a known price, you would have actually finished the day up. If you traded them at 4 o'clock or 4:30 at the end of the day, you would have ended up the day down.
So you've got the sort of proposals out there and regulators are working on these issues, Martin. What should advisors understand or think about until we see some changes taking place and regulators taking some action regarding how to trade these things?
Sure. Exchange traded funds confer awesome and terrific and tremendous benefits on their users, right? They transmit and provide access to thousands of markets, diversified basket of portfolios. They're a third generally the cost of the typical mutual fund and vastly more tax efficient. But nothing is free. So for all those benefits that you get, you have to think about in the life cycle of owning an ETF, right? You have a purchase decision to make and you have a sale decision to make. When you do that, you have to do it with an order that controls the price of your execution. So don't use market orders. Don't trade around the opening and closing of markets when they're most volatile and when the order books are the least liquid. Use stop loss orders with limits on them or use market orders with limits on them.
And then we at S&P Capital IQ, when we do research on ETFs, there's two things that I think investors need to be aware of. One is there's a bid-ask spread, which is not exactly what we're talking about here, but when there's a wide bid-ask spread, when there's illiquidity at the ETF level, it'll widen. That should be a red flag for investors. If the participants are stepping away, it's going to cost you a little bit more. And there's a price to net asset value difference. If that is wider than is normal or is wider than you're comfortable with, that should also be a red flag. So those things are important in addition to the expense ratio, which people probably are more familiar with at the cost of an ETF.
Now, Todd, we've seen the growth of ETFs compared to the growth of mutual funds since they've come into the market really far surpass mutual funds. Is this type of event, if you will, likely to change that? Will investors and advisors start to think twice about using ETFs? I mean, as you mentioned, Martin, they give you such exposure, some exposure that you can't get through mutual funds. There's the expense ratios. Is this a type of thing that might, make people think twice and sort of put a shine back on mutual funds, perhaps?
So we think investors should be going in with their eyes open about the benefits of a mutual fund versus an ETF and vice versa. So the tax efficiency that Martin touched on, the lower expense ratio, the fact that most of them are passive, and it's very hard for an active manager to outperform a passive index and to do so consistently. Those things are all still relevant regardless of what the volatility that we saw from trading, but these are still baskets of stocks and bonds, and if you're not comfortable that not every security may trade at all times when you're buying it, and you're comfortable executing at a 4 p.m. close, then a mutual fund is right for you. If you're willing to accept that there may be periodically dislocation between the price and the net asset value, then an ETF is still something for you to consider, and we don't think that should change.
Yeah. Right. And the data suggests that advisors and self-directed investors are embracing ETFs more than they ever had before. We're going to have another record year in terms of ETF asset gathering, and I think in big part, even that week on August 24th, even though we had dislocations in the morning for sub an hour, you have to take into account the 20-year track records of performance of these products where they've delivered day in and day out, tight tracking, liquidity, low fees, and tax efficiency. If anything, during that week, ETFs made up close to 40% of the total consolidated volume on trading tapes. So actually, people used more ETFs that week than they did in the prior week. So I think that indicates to me that people are embracing them more than ever, and they continue to make up a really important part of diversified investment portfolios.
Great. Okay, well, we'll end it there. Thank you so much for joining us.
Thank you.
Thanks a lot, Greg.